सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The banking sector has been one of the most amazing success stories that this government has been able to pull off in the recent years. From being in a really terrible state, it's pulled it back to quite a strong performance in the last financial year. And now we have the data for Q1 of this financial year. And so we're going to look at whether this success story, this dream run has continued. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And we have with us Radhika Pandey, Associate Professor at NIPFP, who has very kindly analyzed the data for us and is going to tell us about this. So let's get started. So now when we talk about the banking sector, there are a few numbers that come very prominently in mind. And number one is profits.
Correct.
So both public sector banks and private banks, how have their profits been in Q1?
So first we talk about the last financial year,
Right.
because there we have the full picture of the year as a whole, and then we compare with what's happening in the first quarter of the current financial year. So for the last financial year, both public sector banks and private sector banks on a cumulative basis reported profit of more than rupees 1 lakh crore.
Oh.
So that is a very extraordinary record high profitability for both set of banks, for both private sector banks and public sector banks. We've been talking about private sector banks doing well, but public sector banks not doing well. They were in losses 4 years back, but in 22-23 there was a sharp turnaround, and we saw that even public sector banks reported the same level of profits as private sector banks. So that is a major turnaround in the Indian banking sector, that we are seeing not only the private sector banks doing well, but also the public sector banks.
Right.
And that stellar run in terms of profitability continues even in the first quarter of the current financial year.
Oh, that's good news.
Yes. So for public sector banks, profits have more than doubled in the first quarter of the current financial year as compared to the same quarter of last
The
year.
previous year, right.
So their profits have more than doubled. Even for private sector banks, the big private sector banks like HDFC, ICICI, Axis Banks, they have reported profits of more than 30%. So the dream run on profitability continues in the first quarter of the current financial year.
Well, that's fancy. That's actually really good news. And then the other metric when it comes to banks and apart from their profitability is the NPA ratio.
Correct.
And whether the bad loans situation is becoming better or whether it's becoming worse. So far it had been getting better both for public sector and private sector banks.
Yes.
Is that continuing?
So again, for this, we first look at what the RBI's financial stability report talked about. The RBI's financial stability report was released in June 2023, and it gave us numbers till March 2023. And there we saw that the NPAs of the banking sector as a whole dropped to 3.9%. There was a time in 2015 when the NPAs were more than 10%. So they were 11%. And after the asset quality review was initiated in 2015, we have seen a decline, sustained decline in non-performing assets. But the decline has been more sharper for public sector banks. So much so that now we see a kind of a convergence. Earlier, there used to be a big gap between the non-performing assets ratio of public sector banks and private sector banks. I mean, private sector banks are doing better, used to do better in terms of asset quality than public sector banks. But now what we are seeing is that public sector banks' asset quality has improved at a sharper pace, and therefore the NPAs have declined at a sharper pace for public sector banks. And so overall for public sector banks, the NPA ratio is just 5% as per March 2023, from as high as 15% in 2015. So there has been a decline which is a very welcome development for public sector bank.
Right.
And there are a host of reasons for that. There are some good reasons. There are some other reasons. But yes, the good news is that NPAs has declined, and that story also continues in the first quarter of the current financial year, especially if we look at year on year.
Yeah,
Okay,
right.
so we look
Q1
at-
to Q1.
Yes, if we look at Q1, quarter one of this financial year over the quarter one of the last financial year, NPAs have come down. But for some banks, if we see on a sequential basis, that what happened from March 23 to June 23, there is for some banks, there is an increase in the GNPA
I
and
see.
NPA, but we can talk about that later. But overall, yes, the picture on non-performing assets also looks quite good at this point in time.
Now, you mentioned some reasons for this, and we have a question from the audience that touches upon maybe one of the reasons. And the question says, if the loans are being written off or are being assigned to a new bad bank, then it will not be calculated as NPA, which it earlier was. So is this not an accounting hera-fairy, as they call it, to show, to reduce the amount of NPAs that banks have?
So see, writing off of loans has been a phenomenon which is not a recent phenomenon. It was
Right.
being done earlier also. So it's called technical write-offs, where when the loans are not paid for at least 4 years or more, then banks take them off from their balance sheet, and what happens is that they report some amount of losses on their balance sheet. So it's not that it's just taken off and it's done.
Right.
They report, this is a kind of a balance sheet accounting exercise that they do, where they report losses because of this, but they do take it out from their balance sheet in order to minimize their tax liability.
Right.
The other point is that there is a difference between writing off and loan waiver.
Yes,
So,
of course.
so long as this loan is written off, it means that at the headquarter level of the bank, it's written off, it's no longer there. But at the branch level, the loan recovery activity does continue. So that is another point. So it's not hera-fairy in that sense, but when it translates into loan waiver, and when
Yes.
written off is a very large loan written off is a very large proportion of the overall asset base of the banking sector, then it is a cause of concern. But overall, we have see what's happening is that the fresh accretion to NPAs has been declining, which is a
I see.
welcome development.
Okay.
Though if we look at over the last 5 years, there was this reportage that written off loans is amounting to 10 lakh crore, but that is a stock of 5 years.
Yeah.
We are analyzing the first quarter results, and there we are talking about what's happening in the first quarter itself, to the stock of NPAs, what is the new addition to bad loans.
Right.
So that is different from just talking about loan being written off. So NPAs, loan being written off, and loan waivers, these are all separate things. And
Absolutely.
loan being written off is an exercise which banks do to minimize their
As
tax
per-
liability.
And I think it's important to say that the write-offs, the technical write-offs, are as per the RBI's rules.
Yes.
It's not a unilateral thing that banks are doing.
Absolutely.
It's as per set rules that have been set, not recently.
Yes.
They've been in place for a long time now.
Yeah.
So,
Correct. So yeah, that is and there is a procedure to follow to declare a loan as being written off, and there's some obligation that banks need to do. So it's not just appropriate to call it hera-fairy.
right, absolutely. And now we come to credit.
Yeah.
And now this is a tough thing to crack, because it was credit
Yeah.
back in the later years of the UPA
Yes.
that led to a lot of the problems of the banking sector now. And then credit went down,
Yes.
bank loans went down, but it's been growing again. Has that been continuing in Q1? And we'll of course get to the sector-wise breakup, but
Yeah.
overall, has bank credit been improving?
Yeah. So again, if we see what happened last financial year, overall bank credit growth was more than 15%, which is good growth as compared to the tepid growth that we saw in the past 3 years.
Right.
So after 2018, we have been seeing single digit growth in credit, 4%, 5%, 6%. So we saw more than 15% in the last financial year. And in this financial year, first quarter also, that continues. And the growth rate is more than 16% in the first quarter of the current financial year.
That's also good news. So
that's good news also because we have seen a 250 basis points rate hike by the RBI.
Right.
Despite that, we have seen a sharp increase in bank credit. So that is good news. But it's also valuable to look into the drivers of this bank credit.
Which
growth.
is what I was coming to next. Which are the sectors? Because we know that for a while now, the household sector was driving it.
Yes.
But within that also there's a breakup, which
Correct.
I'm sure that you can tell us more about.
Yes. So overall, if we look at the broad categories of bank credit, it's the agriculture, industry, personal loans and services. So these
Right.
are the broad categories. And when we talk about we look particularly at non-food bank credit. So we look at mainly we talk about agriculture, personal loans and services. And there what we have been seeing is, as you pointed out, that, the two main drivers have been personal loans and services. So that was the case in 22-23 last financial year, and it continues. What we've seen is over the last couple of many months, personal loans growth has been around 20%. Services loan growth for the current, the first quarter has been 26%. So these two together have, contributed to the rise in bank credit, whereas credit to industry has been broadly stable. It's growing at a rate of 6 to 7%.
Which is not great.
And particularly it's not growing for large industry, which is a cause of concern.
I see.
And that's a contrast to what we saw in 2008, the overheating, and at that time bank credit reaching 40%.
Right.
Industrial credit rising, infrastructure credit rising. That is not what we are seeing now. So there is a visible compositional shift in the bank credit, and that's also visible in the shares. If we look at the share of these four sectors in the outstanding bank credit, the share of industry has fallen by 3% in just 2 years. So from 21% it has fallen to 19%, and it's mainly due to the fact that the share to large industry has come down, whereas the share of industry and services has increased. So that's on the broader level.
Right. And so actually coming to that about just industry, the point you had made, there is an audience question which is asking about that what is the reason behind the slowdown of bank credit to the manufacturing industries? Is there a concern about NPAs in these industries, or is it something else?
So we've done this work of looking at the balance sheet position of banks and looking at their investor presentations, what they make to the investors, their conference calls that they do. So they also report segment-wise NPAs, and there we see, interestingly, it's not driven by corporate loan. So the NPAs of companies are not rising as was the case in 2008-9. Whatever sources of stress that we are seeing in the first quarter is again coming from personal loan and to some extent MSMEs, micro, small and medium industries. So these are the two sources where we are seeing some increase in NPAs on a sequential basis, that is from March quarter to June quarter. In absolute levels, the NPAs has increased for personal loans and MSMEs, but that is not the case for corporate. And a main reason for that is again because of the flat growth of credit to corporates. It's mainly being driven by personal loans and services. So when you are giving more loans to the personal and the retail sector, household sector, the possibility of some of that loan turning SAR is also applicable there.
Right. So I was actually going to come to that it can't possibly be that every single data point is positive and that everything is going well. Are there any points of concern that this data is bringing out?
Yeah. So in personal loans, first look at the category. What constitutes personal loans.
Right.
So So that is the first concern, that personal loans, mainly if you look at the share, the two main big components of personal loans are housing loans and vehicle loans. So these are the two big components which constitute more than half of the overall personal loan segment.
Right.
But what we've been seeing over the last few months, particularly last 4 months, what we have seen is that there are some small components of personal loan that have reported growth rate of 30%, 40%. Some of these are credit card exposure.
Right.
Another one is advances against fixed deposits. And the third one is loans against gold jewelry. These are very small components of personal loans having share of less than 2%. But what is happening is that in each of the last 3-4 months, we are seeing that the growth of loans in these segments is rising exponentially.
Do we know why?
So one reason, loans against fixed deposits, because maybe banks are turning more cautious because they have seen that in their balance sheet, personal loan NPAs have started to pick up.
Right.
So now they are giving loans only on the collateral of fixed deposits. So if you have a fixed deposit, then you can get advances against fixed deposits, and that's good for customer also because you have to pay lower interest rate. So that's a kind of a secured loan. Why? Because the RBI also in its financial stability report raised this concern that uncollateralized loans proportion has been rising, which is a cause of concern. So maybe that is the reason that loans against fixed deposit, which was a very small component and used to report some stable growth number, the growth has recently increased over the last 3-4 months. So that
similarly, I'm guessing with gold, because it's a stable asset.
Yeah. So
I see.
So that is one very interesting composition that we saw in the personal loan. And in services, what we are seeing is that NBFCs have been borrowing a lot from banks. So NBFCs loans to banks loan to NBFCs have been again rising at a very sharp pace, growing at a rate of 30%, 35%, so much so that in the overall bank credit, the share of NBFCs, non-bank financial companies, have risen. They can borrow from other sources by issuing bonds, by issuing commercial paper, but because of some changes in taxation rules that happened during budget, mutual fund attractiveness towards the NBFCs has gone down, and we are seeing that the reliance of NBFCs to banks has risen. Now, as of now, it is fine, but if there is too much interconnectedness between these two very prominent sectors of the financial system, it could lead to systemic risk concerns. So
especially like in the past, there were several NBFCs that went under and that created a panic, and we don't want a repeat of that.
Yes. So this is something that warrants careful observation. What is happening to NBFC's reliance on banks? Is it rising? It's getting too much concentrated to NBFCs? So that is something that needs to be seen, because over the last 3 years, we have seen an increase in the share of NBFCs. So that is another concern. And lastly, what we are seeing is that the net interest margins of banks, which is basically the difference between what banks earn from advances, the loans that they give, the interest rate that they earn, and the interest that they pay to depositors. That margin is now shrinking. So
I see.
That was the main reason for the increase in profitability that we saw in the last financial year, because repo rate was rising. We saw in the entire last financial year, repo rate was raised by 250 basis points. And whenever repo rate is raised, the lending rates of banks also immediately rise, because they are benchmarked to the repo rate. But deposits rate take time to recalibrate. So, but now what's happening is that now if banks are scrambling for funds, if they have to give loans, they have to attract more depositors. So they have to pay higher interest rate to depositors.
I see. So the difference then is
narrowing. And that is why, so for example, for State Bank of India, which is one of the biggest bank, which accounts for almost 40% of the overall bank credit, the net interest margin has shrunk in 1 quarter by 37 basis points. So for domestic operations, for overall, it has declined by 27 basis points. So we show in our article for top 5 public sector banks, out of which in 3 they have reported a deceleration in the net interest margin from March quarter to June quarter. So this is something that needs to be monitored. This is going to happen. The supernormal profits that banks earn because of higher net interest margin, that is now going to
Get
normalize.
normalized, yeah.
That's going to normalize. In the coming quarter is going to normalize even further, because we know that now we see banks' liquidity has slumped after
Yes.
the incremental cash reserve ratio. So banks would need deposits, banks would need funds, and they would have to pay higher interest rate, and that will have a bearing on their interest margin.
But this is not an indication of the health of the banks, that just because their profits are normalizing doesn't mean that they're suddenly turning unhealthy.
No,
it's still still a healthy move.
Yeah, it's healthy move. It means that they are normalizing, because one of the reasons for higher profits was higher net interest margin.
Right.
So we should now that the net interest margins would shrink in the coming quarters, depending upon how much they offer as higher deposit rate. So net interest margins would shrink, coupled with the fact that if we see in personal loans NPAs start to increase, these two factors in tandem could impact the profitability of banks. Because if there are higher slippages, that means there are higher NPAs in any particular quarter,
Right.
then banks have to make provision. They have to set aside some amount of funds for that. So overall, these three factors cumulatively could impact profitability of banks. But these are very initial signs, and they may not materialize. It's just a 1 quarter thing. But the fact is that we are seeing these things like NIMs getting more normalized, and slippages and NPAs in the personal segment we are seeing in a few banks. So these are something that just need careful observations.
Right. So now we've talked about the great state that banks are in. There are a few concerns. There's a question from the audience, which is about what are the reforms that should be implemented in the sector and why are they getting delayed?
So some of the reforms have been implemented, like we've seen that banking regulation has improved as compared to what we saw 4-5 years back. Regulatory forbearance has become much more focused. It is not like the extend and pretend kind of scenario that we saw in the 2008 episode. That has become much more cautious. RBI has become more cautious. It has become more stringent in terms of its supervisory capacity.
Right.
So there were concerns with the RBI supervisory capacity, but it has improved, though there is scope for further improvement, but there has been an improvement there. The other thing that we've talked about earlier, also in connection with the Silicon Valley Bank episode, was that one regulatory vacuum that we see is the financial resolution.
Yes.
The resolution of troubled financial firms.
Yeah.
So that is something that is still missing, and we need to have a framework for prompt resolution of troubled financial firms, so that it's not just every time the State Bank of India that comes to the rescue of firms to merge with and resolve. So we need to have some framework that will give rise to, that will allow RBI to be more liberal with having more licenses for banks. So there should be easy entry and exit of financial firms from the sector. So that is another thing. The one reform that has been done is that the deposit insurance cap has been raised, which is a reform. Some reforms have been implemented in the sphere of cooperative banking sector, where we had a dual regulation, and some part of that has been addressed by giving more powers to RBI.
Yeah.
So all these things are being done, but yes, it's a work in progress, and much more needs to be done to make the financial system more resilient.
Right. And now our final question possibly has to do with one of these reforms. The question is that why is the digital infrastructure of banks, of Indian banks, still lagging? Banks in the US are trying to downsize their branch sizes to cut down on their costs and provide cheaper services, but we don't see this happening in India, the question asks. But I believe that it is happening.
It is happening. So there are two different things that are happening. One is, if you remember last year's budget, there was a proposal to set up digital banking units. So 75 digital banking units were set up to commemorate 75 years of independence.
Right.
So that is digital banking units of the existing banks. So RBI issued a regulatory framework to set up digital banking units for existing banks.
Right.
So that is something on which progress has been being made. The other is there are neo banks which are in partnership with the existing brick and mortar bank are providing digital services. In tandem, the Niti Aayog released a working report on digital banks.
Right.
So that is something which did not go down well with the RBI, because RBI thinks that there's already so much happening on the digital front, so much happening on the financial inclusion front. We have the small finance bank. So they have not taken that idea with great enthusiasm as of now. But on other spheres like digital banking units, partnership with fintech firms, embracing artificial intelligence and business analytics to make loan decisions, all these are taking place in the banking system. But this entire idea of setting up of digital banks did not go down well with the RBI because of their own concerns that, what will happen is that these promoters may not have that experience of extra governance, the corporate governance that is required for running a bank. So that way RBI is more cautious and it has not gone whole hog with the idea of digital bank. But in other spheres, digitization in the Indian banking system has started and is going on.
Right. So there you go. Now this is what we have, the snapshot, the Q1 snapshot of the banking sector. Overall, it looks like a lot of the good news is continuing. Profits are rising, profits are quite high. The NPA ratios are coming down. Bank credit is increasing. Here, there are a few points of concern where industry's share is still kind of low, especially large industry. The loans to NBFCs are rising as a share. They're still manageable, but if this continues and they become too high, then risks to the entire financial system could grow. But overall, it looks like the banking sector is in good health, which is good news for the Indian economy. And on that note, that's all from us. Thank you so much for watching.